Hi, my name is Daniel Vasquez. I'm an owner and managing partner of Ophir Financial. It's spelled O-P-H-I-R Financial. Our company's focus is to help individuals and families build their financial stability and then continue building on to their wealth. Today, we're going to be talking about the basic fundamentals of insurance policies. There's two that we're going to focus on. One is the term insurance policy that you may have heard of, and of course a whole life policy, which I believe is in most cases misunderstood as to what you can use it for. And that's what we're here to do, is to help. So this presentation is to talk about what we call a death benefit. In insurance, there's always a face policy of a death benefit. And in this particular case, we're going to use a $500,000 face value of the policy, which is the death benefit as well. Now, as I mentioned, we're going to talk about the term life insurance as well as the whole life policy and what the differences are and how you can use them. The term, coming back down here as I'm presenting, is that it has a minimum to it. The minimum meaning the policy face value. Policies are usually set at a minimum of $100,000 to $125,000 minimum as far as protection is concerned. That minimum is set up by the insurance carrier, or what we call insurance carrier, which is the insurance company. Let's assume, as I'm presenting here, that there is a payout of the year, your payout, your premium of $500 every year for that term insurance, if it could give you $500,000 of death benefit. We're using $500,000 in this case, just as an example. Term insurance is the basic fundamentals of insurance. This is how the insurance industry actually started. You pay a particular premium, they give you a death benefit over a particular period of time. They're the risk takers. They're the ones that are taking the risk at this point, or that one, your premiums will last all the way out till your death benefit is paid. You're paying the benefits on a term insurance because, one, if something happens to you between point A and point B, which is the death benefit at that point, earlier, then they take the risk of actually paying your beneficiary $500,000. That's the basic fundamentals of insurance in the term life insurance policy. Keep in mind, there are other provisions that you can add to the term policy, such as the ability of extending the term policy or converting the term policy without taking another physical exam, as an example. Okay. Those are some of the things that they add as riders, if you will, to a term policy. Let's talk now about a whole life policy. As I said in the beginning, I think the whole life policy sometimes is misunderstood as to why that was developed. It was primarily developed so where it could be a financial instrument. A financial instrument because you are investing money into this particular contract. Okay? This particular contract has the ability of taking that cash that you put in and using that cash, but at the same time provides you an interest rate back to it. In other words, an interest gain of some type. We'll talk about that in a little detail a little bit later as to what that account actually has. As you can see, we put a payout that's a little bit higher, not a little bit higher, higher than the term life policy. it's a $10,000 payout per year for the $500,000. But again, the whole life policy is designed as an investment. I personally call it a financial instrument because of the fact that you're investing money into it and it is growing in interest at that point. So from that standpoint, I look at it as a financial instrument. Let's continue on and talk about there is a maximum. I like to consider it a cap of how much premium you can put in to a particular contract at a particular death benefit. The maximum is set by the government. The government has come in and said, well, at this point, what we will allow you to do is to put premiums in, but you still have an upside of death benefit between what you put in and what the death benefit is, simply put, okay? Therefore, there still is a risk there. Therefore, it's still considered life insurance, okay? If those two elements meet together, in other words, the amount of premiums that you put in and the death benefit, it is called a MEC, which is basically called a modified endowment contract. Now, we're going to talk about that in detail maybe at the end of this presentation, but primarily to show you that we can grow the whole life policy in different ways. But let's talk about what the government is offering as far as programs to help you with your retirement, what we call in Oak Sphere Financial, the end of your working years, okay? These are called qualified plans as I present here with my cursor. They're called qualified plans. Underneath there, you should see the IRA, the 401k, the SEP, the 403b, which is basically for nonprofit organizations. They all have different characteristics in them, and we're going to put a series on exactly what you can do with each one of those, as well as other government programs. But in this particular case, we talk about the basic fundamentals of these programs. As I present here, they defer, these programs, these qualified plans, they defer the tax and the tax calculations to later. In other words, what you're saying, as I've outlined here in pink, it says deferred, really means postponed. They'll move it to the back end when your working years are over, your retirement is ready to be implemented. Then at that point, they determine all your assets, your insurance policies, etc. This is the tax burden that you receive at that point. Now, there are other questions that come up, and I'm always asked about this, and I ask, what tax bracket will you be in at retirement? The tax bracket at retirement is kind of up for grabs, if you will, at this point. It depends on where you're getting money from and whether you're using an exchange program, which is an exchange from an IRA to an annuity, or a 401k and moving it into annuity, which is an insurance type of plan, as well as other types of financial instruments. So that determines your tax bracket, that determines your retirement amount and how you're going to create your income and with what. The other question is, what deductibles will you have when you take your money, because that becomes somewhat of an income scenario. Tax deductions at the age of 65 are probably minimal, so you don't have a way to offset that tax position, simply put. Now, we're going to start talking about the whole life policy and the differences between a qualified plan, the whole life policy, and of course a modified endowment contract. And what the government says is the minimum that you can do with a whole life policy. Now, what we're going to talk about are the provisions within the whole life policy, which has a face value of $500,000, the death value that is, and that is that it is a tax deferred growth program. In other words, you're not taxed on the increase that you receive because that is creating an interest and, in our particular case with our carriers, a dividend back to you, and you're creating an increase in wealth, if you will. Okay. In addition, as I'm presenting here, it's tax-free distribution. What they mean by distribution, at the end of your working years, you want to take that money out and create an income for yourself. That's called the distribution point. That distribution with the whole life policy, because it's an insurance policy and personal property, now it is a tax-free distribution. It's an important thing to remember. Competitive return. Whole life policies at this point are also creating an interest gain for you every single year. And we're going to talk about where your cash account or your cash value of your premiums enter into the whole life policy. Well, what's happening now with our companies, they are being very competitive compared to other investment issues that are more secure than just the market itself. High contributions means that in going back to the qualified plans, there's a maximum that you can put in here. High contributions allows you to, in a whole life, you can put additional contributions into that whole life policy as long as it doesn't meet the modified endowment contract. Now, additional benefits of whole life can be things such as disability insurance, which protects your income, auto pay. If something happens that you can't make premiums at this point, your cash value that you have in there will help make those premiums. Those are some of the added benefits that you can attach in form of riders, if you will. Collateral opportunities / borrowing. This is one of the things that we had focused on early with Osphere Financial, because we were in the property business at this point. The mortgage business is how Osphere started. We started to realize that we needed to help with an instrument, a financial instrument like whole life, that becomes personal property, because it has value at this point as personal property. It can be used as a form of collateral. Okay? Because it's a form of collateral, it can also be borrowed on. In other words, you can borrow because your money is securing that a lender. Okay, we'll talk about that in detail. Now, safe harbor. Safe harbor moves money into a place, into a financial instrument. Because of high regulatory issues at this point, people can't get to that money if you're being sued, as an example. Or IRS. It's protected because it has a safe harbor clause in that contract, and it is accepted by all parties. No loss provisions. Guaranteed loan options. We're going to talk about that when we start talking about things such as borrowing off of a whole life policy and how do you go about using it and using it properly. The key word is using it properly, continuing your idea of your retirement, the end of your working years from here to here. That's what I mean by properly. Unstructured loan payments, as I mentioned just a few minutes ago with the whole life policy, here's your premiums that meet this MAT, which that premium could be somewhere in that area or a little or below. But you could also have the opportunity of putting additional funds in there within that year's period of time, as long as it doesn't meet that modified endowment contract. Liquidity use. In other words, your cash premiums that are being put into this particular contract, the whole life contract, is liquid. It's available to you. Okay, you can take it out at any time completely. Okay, you have control over it. There is a period of time before it can be collected and increased in equity, if you will, or interest. Now we're going to continue by taking a look again at the death benefit right here at $500,000. And we are presenting, as I show up here, a cap of what we call the endowment line, or what I call the endowment line. So the death benefit is presented here in the beginning, as soon as you sign your agreement and contract, all the way up to its whole life term. Now, that's $500,000. In addition, what we're going to present is your premiums are starting to create a cash account. Cash account meaning that you have cash value in this account, in this program right here called a whole life policy, a financial instrument. So you are actually investing in this contract. I use those terms because it separates the idea that it is just a life insurance policy. It has other characteristics very similar to a financial instrument. So now you have cash value, as I present here in green, going into your policy. After that period of time, after a year's period of time, you also receive something called a dividend. I mentioned possibly in the previous presentation on the entire scope of what we do prior to this one, is that one, we made a selection of particular providers that would be able to provide a dividend to our client in addition to the cash value. You have a compounding principle here with your cash value, along with the dividends coming in at the end of the year, which again compounds in interest the following year and the following year and the following year. So you have a steady increase of gain, if you will. Now, with those two things said, one of the things I should explain about this contract, it is still a whole life policy, a life insurance policy. And many years ago, there were two things that were considered for it to be not only a life insurance policy, but also personal property because you've invested money into it. And the insurance industry and the court and IRS finally decided that, one, you had to have what they call insurable clause. It was a front load, if you will, and he called it, as I represent right here, insurable interest period. A period of time that says you actually purchased this product because you wanted to insure assets. You wanted to insure and protect your family from loss. Okay, so I call this the front load as well. This is where a carrier actually takes money as for their expenses so they can actually implement this contract. I particularly call it a front load period. It is at this time after the 2 years, or depending on the contract, because there are other whole life policies that will take it all the way to 5 years at this point. And there's a difference in the way they actually provide you an interest rate at that time and your premium cost. So that period at this point is set when you start your contract and you decide, well, this is my premium, etc. And the reason you might want to do that is because if it is a long-term program, you are putting more money into your premium, but you're also putting in more money so where you create this compounding effect rapidly. So that's what we help you with, make a decision on, is which one is best for you depending on how you want to use that program. So there's a lot of flexibility in what we can do here. Now, there's something called paid up additions. Now remember, the reason I was in this particular slide was showing you that we can create an increased value in this whole life policy because of the type of companies that we have selected at this point. They provide a dividend to owners. You, since you're a policy owner in a mutual company, are an owner in that company. What we do, or what they do in this policy with dividends, which are profits, they take that profit, create a dividend at this point, and they bring it into the contract and elevate the contract. What I mean by elevating is that, one, they're going to find a way that they're going to increase this MEC line from here up to here by taking the dividends at this point, right here, and creating what they call paid up additions, meaning that they are providing additional insurance because they're taking this overage of profit and putting it into your contract, which raises the value of this $500,000 death benefit. And I'm trying to present that right here in this line. You see, we were at 500. They took up the paid up additions, put it into the policy, which created a policy now at $800,000 as an example. Okay. So now there were some other issues, provisions that we talked about, was increased premiums and flexible premiums in this contract called the whole life policy. There is a way to provide additional money into here to actually increase your cash value. And you can do it over a year's period of time only if it doesn't meet the MEC. And that's one of the things we help you with after you make a purchase of that whole life policy. That's what we're here to help you do and determine. Here's extra additional funds that you may have received from another asset that you cashed out that you want to put into your life insurance policy for the end of your working years. You can only do it within that period of time, not to meet the MEC at this point. So we help you manage that process. I'll make one other statement about that, and that is there isn't any reason why you can't buy or purchase another contract, a whole life contract, to increase the value of what you have within those contracts. We can talk about that in detail as well. So at this point, we're pretty much at the end of presenting the endowment. And I want to take the time to kind of talk a little bit about what Osphere is trying to accomplish as a service to you as a owner. One, we help you plan. To me, that's one of the most important things that we can help you with, is let's start planning the process. Even if it's all a matter of just starting with a term life insurance policy, you need to have the right term life insurance policy. So if something happens to you medically at this point, you don't have to re-qualify to grow it into a whole life policy. So that's what I mean, is we need to plan things out, even right from the start, even if all you need is just a term life insurance policy. Now, protect. With that life insurance policy, we want to start the process of, we need to protect the assets that you have. So we're going to ask you about, let's qualify this a little bit. You know, what's your income level? What are your assets that you have out there, etc. So we can say, well, your term life insurance needs to protect this. Your whole life insurance needs to have this face value, this death benefit value, as I presented earlier. Increase wealth. We talked about that because you know that you have cash value coming in, you have dividends coming in, you're increasing that wealth. There's other features that we use to help individuals so they can manage their money. There are other presentations that we probably will be sending you, and that is, how do you go about using the cash value that you have in your policy to purchase something big and not give that money to somebody else, but maybe borrow it from the insurance company, the carrier at this point, not your policy. Your policy keeps growing, and then you start making payments back to your, what you would call a internal bank. We're going to talk about that in detail. Keep in mind, our primary objective is to take a family financially from the beginning of their working years to the end of their working years, and in addition to beyond their working years. Because it's like growing your program all the way up to the top of the mountain at this point, and you get to a place where you have enough money, you've grown enough money that your lifestyle is not going to change once you quit working. To us, that's an important view. And we take tools with companies that have provided us tools and we've registered with, and that is people like Wealth Builders Cornerstone, Wealth Building Cornerstones. They have calculators that allow us to show you from here to your beginning years to the end of your working years, that one, you have enough to take you beyond that point, all the way to where you're not with us any longer. So that's the end of our presentation. Would like to tell you that if you have any questions, we have a website, which is www.ophirfinancial, all one word, .com. You can send us an email, and I'll have one of our representatives or myself answer any questions that you may have about the idea of using this type of a program, or for that matter, other types of programs to help you build your wealth in the retirement stage, or build your wealth so where you're able to use some of that money for other opportunities. Please, we thank you so much for listening. Be good to yourself, and remember, we're here to help.